Daimler is getting a new name. From Tuesday, the German car maker will be known as Mercedes-Benz Group after its flagship brand. It's a move that CEO Ola Källenius believes could raise the value of the company. He did not name a specific target valuation for the firm though. Right now it's worth just over $85 billion. One analyst said the rebrand could help the firm persuade investors to see it more like Tesla, particularly as Mercedes pursues an electrification strategy to compete with the US firm. Källenius also gave a hint of where the company's future might lie. He talked up self-driving cars and said it has significant business potential for the future. The change is the latest in a run of restructures for an automaker dating back a century or so. In the year since the move was first announced, Mercedes-Benz shares have risen to their highest level since 2015. They hit their peak when it was announced Daimler Truck would spin off into a separate entity. That split went ahead in December.
Car makers have taken the headlines, but it seems parts shortages are hurting household goods makers too. On Friday, Electrolux said supply chain problems meant it couldn't meet demand. The Swedish firm is Europe's biggest maker of fridges, washing machines and the like. It owns numerous other brands, including AEG and Frigidaire. In the fourth quarter, its profit tumbled to about $94 million, around a third of last year's level. Now Electrolux says supply chain problems will continue to hamper its ability to meet demand. It also faces a battle against rising costs for raw materials, components and logistics. Overall, it said the first quarter would be every bit as tough as the fourth. However, the firm thinks price rises can offset at least some of its soaring costs, and it expects demand to exceed pre-crisis levels. Shares in the firm were down around 4% in afternoon trade.
Americans crimped their wallets last month as inflation heated up to historic levels. The Commerce Department reported Friday that consumer spending, which accounts for more than two-thirds of economic activity, dropped 0.6% after gaining in November. Behind that decline, surging Omicron infections reduced traffic to restaurants and bars and other venues, and fear of shortages of goods at stores likely drove Americans to get a head start to their holiday shopping instead of waiting until December. Those shortages caused by snarled supply chains drove inflation higher last month. The Personal Consumption Expenditures Price Index, which the Federal Reserve watches closely, climbed at a 5.8% annual clip, the largest advance in 4 decades. With inflation running way above the Fed's target, the central bank signaled Wednesday it's likely to raise interest rates in March. Wall Street ended a tumultuous week Friday, rebounding sharply from a morning sell-off in a volatile session. Tech stocks were the standout in a broad rally led by Apple. The Dow added over 500 points, gaining nearly 1.7%. The S&P 500 shot up nearly 2.5%, and the Nasdaq catapulted over 3%. The major indexes gained on the week, and the S&P snapped its 3-week losing streak. Investors looked past data Friday showing consumer spending falling in December as inflation climbed at its fastest pace in 4 decades. But Gerber Kawasaki CEO Ross Gerber is not worried about inflation or the Omicron variant.
We see both of those trends now reversing as Omicron is now fading in the United States, and we're going to see costs start to come down and people get back to jobs and work and back to the offices again. So we're very bullish on the spring.
Springing higher, Apple up 7%, one day after the company posted record sales of iPhones in the holiday quarter. Visa charged up nearly 11%. It was the top gainer on the Dow and S&P. Higher spending on international travel and commerce helped push earnings past Wall Street's targets.
As Lunar New Year draws near in China, a flower farmer's stock goes up in flames. That after Hong Kong's stringent measures against the Omicron variant have halved his demand. 70-year-old Lun Yet Shan runs a traditional farm in Hong Kong's rural Yuen Long district, where he grows sword lilies, water lilies and tulips. He had planted 200,000 flowers for the celebration, but was unable to offload about half of them due to the crash in demand.
These beautiful flowers are completely healthy. and I would normally pick them and bring them to market. Look how pretty they are. But due to the epidemic this year, there is no flower market at all. So after they've blossomed, I have to get rid of them all by burning them, so they don't stay in the ground and rot.
Lun has been able to sell some flowers directly to customers at his farm, which he runs together with his wife and 3 employees. But on January 14th, the government announced that traditional Lunar New Year flower fairs in around 15 districts would be closed because of the pandemic, in line with the territory's zero-COVID policy. Traffic restrictions on locations traditionally used by wholesalers were also put in place.
Over there is the source of my income for the year, worth 6 figures. These flowers are all in season and could have been sold. And here at my farm, we're fair about the price too. I don't exaggerate or hike the prices. My income depends on Christmas and Lunar New Year sales.
Government figures show compensation has been offered to license holders of Lunar New Year flower fairs, but Lun said he has received nothing as a farmer. The only financial stimulus he has had from the government was the chance to draw an interest-free loan as part of an anti-epidemic fund. As the highly transmissible Omicron variant spreads, there have been over 600 locally transmitted infections in January so far, compared with just 2 in December. That, despite Hong Kong's success in keeping the virus under control for much of 2021.